Friday morning, 10 minutes after the lock turns, the first customer is already back. She repaid her last loan from the paycheck that arrived before sunrise. Now, rent is due, the refrigerator is empty, and the same counter is the only place promising cash before lunch. The operator recognizes her coat. The business earned a fee when she repaid. It earns another if she borrows again. That distinction matters. A single repaid loan can make money, but the customer who leaves forever has low lifetime value. The customer who nearly catches up and returns next payday is the account the storefront is built to remember. This story follows one fictional composite storefront through a single week. No company, employee, or borrower in it is real. The transactions are illustrations built from public research about payday lending. The point is not to invent a villain. It is to sit behind the counter and watch which outcomes keep the lights on. The store sits between a laundromat and a discount phone shop. Its windows are brighter than either neighbor. The room is clean, the chairs are bolted down, and the counter glass rises to chest height. Nothing looks secret. The model works in public because urgency is common enough to need a permanent address. On Monday, the returning customer was new. She needed $300 before the next paycheck. The fee was $45. The amount due was $345 in 2 weeks. The arithmetic fit on one page. The missing information was what the next paycheck already had to cover. $45 sounds like a service fee. The term is short, so the charge appears contained. The Federal Trade Commission explains the annualized comparison. A typical 2-week fee of $15 per 100 borrowed corresponds to an annual percentage rate of 391%. The short clock disguises the scale. She does not owe a year of interest. She owes one fee in 2 weeks. That correction matters because annual percentage rate is a comparison tool, not the amount on her receipt. The danger appears when a supposedly brief transaction repeats. Then the annualized number stops feeling theoretical because the calendar keeps returning. The operator asks for identification, income, and access to a checking account. He does not build a conventional credit portrait. The current Consumer Financial Protection Bureau explainer says payday lenders generally do not verify whether repayment can coexist with the borrower's other financial obligations. The payment channel can matter more than the remaining budget. The loan is designed to meet the paycheck before rent, groceries, utilities, and every other claim on the same money. Repayment can succeed while the household still fails. That is the first hidden mechanism. Collection and affordability are not identical outcomes, even when the register records both as a completed transaction. He approves the loan because the checklist is complete. No dramatic decision occurs. The printer moves, the drawer opens, and the customer leaves with cash. She is relieved. He is courteous. A harmful structure does not require cruelty in every interaction. It only requires incentives that remain stable when everyone behaves politely. Suppose she repays $345 and never returns. The store keeps the $45 fee. That is revenue, not failure. But acquiring, serving, staffing, and collecting one small loan all cost money. A borrower who returns lowers the business cost of finding the next transaction. Familiar faces are commercially valuable. Behind the counter is no scoreboard labeled desperation. There is a schedule. Due dates, expected payments, available cash, and staff hours share the same week. The operator can describe everything as operations. That language is accurate and incomplete. It turns a household emergency into a predictable line of store traffic. Tuesday is quieter. 3 regular customers arrive before noon. One needs a smaller amount than last time. One asks about extending a due date. One pays in full and waits beside the door before asking for another form. The operator does not need a marketing campaign. The calendar has brought the market back. A Consumer Financial Protection Bureau data study found that 4 out of 5 payday loans in its dataset were renewed or followed by another loan within 14 days. Roughly half of the loans were in sequences of 10 or more. These are historical findings from a large dataset, not a live count of every store today. The same research leaves room for a fact that moral storytelling often erases. Some borrowers repay quickly and stop. Some use the product as planned. Access to emergency credit can solve a real timing problem. The concern is not that every loan becomes a trap. It is that repeat sequences produce such a large share of activity. From behind the counter, individual stories dissolve into a portfolio. One customer disappears after one fee. Another pays fees across several cycles. A third defaults and enters collection. The operator does not need every borrower to return. He needs enough repeat transactions to cover the accounts that leave and the accounts that fail. This is why repeat rate is more revealing than the price posted at the window. A fee describes one transaction. Repeat rate describes the relationship. If the same principal generates another fee before the household has recovered, the store has converted one emergency into recurring demand without creating recurring income for the borrower. Wednesday brings a paycheck schedule for another group. The morning register fills with repayments. From the store's perspective, this looks healthy. Cash returns, contracts close, drawers reconcile. But several customers remain in the lobby after paying. Their next decision reveals whether repayment restored liquidity or merely moved the shortage forward. One customer had enough to repay the lender, but not enough to finish the week. That is the economic hinge. She did not fail to pay. She paid successfully and became short again. The counter can record a clean repayment and a new loan on the same day, while the household experiences one continuous shortage. In many repeated sequences documented by the Bureau, borrowers did not steadily reduce what they owed. The amount on the last loan was often at least as large as the amount on the first. Fees moved. Time moved. The principal remained. The operator sees new contracts. The borrower feels the same missing money wearing new dates. He learns a sentence that sounds helpful. Keeping the account current protects available options. The sentence is not necessarily false. A default can reduce options further. But inside this room, staying current may require buying the same option again. Help and retention can occupy the same words without being the same purpose. He does not laugh after she signs. He does not need to. The store's incentive works through ordinary competence. Fast processing, remembered preferences, a clean lobby, and a product available when alternatives have failed. The most durable financial villains rarely feel villainous from the chair they occupy. They feel efficient. The storefront stays open because the need renews faster than the balance sheet of the household can recover. Rent arrives monthly. Food runs out daily. Paychecks arrive on a schedule that emergencies ignore. The lender does not create every shortage. It positions a fee at the narrow bridge between one shortage and the next. That distinction prevents an easy mistake. Closing one store does not repair the car, lower rent, replace a missed shift, or make a paycheck arrive sooner. Emergency liquidity is a real need. A product can exploit that need and still be filling it. Both facts must remain visible, or the analysis turns into a slogan. On Thursday, a borrower cannot make the full payment. State law matters now, and state rules vary. Some places permit renewals or rollovers. Some restrict them. Some do not permit payday lending under the available terms. This composite store uses no named jurisdiction, so it cannot pretend one legal path applies everywhere. Some state frameworks provide extended payment plans that let eligible borrowers repay in installments, sometimes without added cost. A Bureau market snapshot found those plans were used less often than rollovers and defaults in the states studied. It also observed that lender incentives can favor higher-cost rollovers over lower-cost plans. The operator can comply with disclosure rules and still control emphasis. One path gets explained first in familiar words with a form already waiting. Another receives a shorter explanation after the customer is tired. Choice architecture does not require hiding an option. It can work by deciding which option feels ready. If the borrower enters a no-cost payment plan and does not return, the store recovers principal, but may collect less additional fee revenue. If she rolls over or reborrows where permitted, the relationship continues. That does not prove every employee suppresses alternatives. It identifies the direction of the incentive built into the transaction. Rules can limit fees, renewals, payment attempts, or product availability. They cannot make a thin paycheck cover a thick month. Regulation changes the bridge. It does not remove the gap. That is why the market can migrate into installment loans, online products, overdraft, or other forms when one structure closes. Current federal payment provisions generally stop a covered lender from initiating another transfer after 2 consecutive failed attempts, unless the borrower gives new and specific authorization. The rule targets repeated account debits that can trigger added bank fees. It governs collection behavior. It does not declare every covered loan affordable. By Thursday afternoon, the operator reviews the week. New customers brought fees. Returning customers brought fees without another street advertisement. Repayments restored cash. Defaults consumed staff time and created uncertain recovery. The spreadsheet rewards repetition without ever containing a column called dependency. Accounting names transactions, not the condition producing them. A sign, a location, and an open door acquire the first visit. The due date helps acquire the next. Once the store knows the paycheck rhythm, marketing becomes calendar management. The borrower does not need to be persuaded that cash is useful. The next shortage performs the persuasion for the business. In ordinary retail, repeat customers often signal satisfaction. Here, repeat use can signal that the product did not restore the customer's position. The same metric can carry opposite human meanings. Higher lifetime value may look excellent in the store's books precisely when the borrower's financial recovery keeps moving one paycheck away. He has a defense, and parts of it are true. The customer chose the loan, the price was disclosed, cash arrived quickly. Other creditors had said no. The store took default risk. The defense becomes incomplete, where it treats consent at the counter as proof that the repayment structure fits the month. A signature can be voluntary and still occur inside severe constraint. The alternative may be a late rent charge, a dark utility account, a missed shift, or a car that cannot reach work. Urgency does not erase agency. It changes the price of saying no, which changes how much a signature proves. Then Friday returns to the opening scene. The woman in the same coat sits down. She repaid before sunrise and has less cash than the morning before the first loan. The operator knows the process will be faster this time. Her documents are familiar. Her need is not. The system calls this a returning customer. The first fee bought time. It did not buy income, lower rent, cheaper food, or a repaired monthly budget. Time can be valuable. But when the due date arrives before the underlying gap closes, time returns as another bill. The product solved the calendar and intensified the amount waiting on it. He sees identification, income rhythm, amount requested, amount due, and prior payment behavior. He does not see the refrigerator, the landlord, the car repair, or the shift schedule, except as fragments in conversation. The counter reduces a life to fields because fields are what the transaction can process. She sees a door that opens when other doors stay closed. She also sees a familiar fee that feels smaller than the emergency outside. Neither view is irrational. The trap emerges from how both rational views connect. Urgent demand meets a product whose economics improve when the demand returns. A common misconception says the lender wants every borrower to default. Default can be costly, uncertain, and operationally heavy. The cleaner revenue event is payment, followed by another fee-bearing transaction. The ideal repeat customer is not someone who never pays. It is someone who pays often enough to remain eligible and returns often enough to remain valuable. No individual employee has to design a personal trap. Product term, fee, repayment timing, access to the bank account, and weak affordability assessment can produce the pattern together. Design lives in the relationship among those parts. When research repeatedly finds fast reborrowing, the repeat rate becomes a property of the product, not merely a list of bad choices. The borrower is a person with a timing problem. The business model is the set of incentives around that problem. Separating them matters. Shame focuses attention on her judgment. Analysis follows the fee, the due date, the repeat transaction, and the store's reason to keep the circular path shorter than the exit. The operator is also not the whole system. He works inside state law and federal payment rules. Rent, payroll, capital costs, default risk, and competition surround him too. Replacing him does not automatically change the product, but his chair reveals the metric that matters. Not how many customers leave with cash, but how many transactions each shortage can generate. A product that earns more when the borrower recovers would look different. Payments would fit disposable cash flow. Success would reduce repeat emergency use, rather than celebrate it. Lower-cost installment paths, transparent alternatives, and underwriting that asks what remains after repayment move in that direction. None creates money where a household has none. At closing time, the woman leaves with another envelope. The store has helped her through Friday and improved its weekly numbers. Both statements are true. The conflict is not hidden inside one of them. The conflict is the connection between them. The store's reliable revenue and her unresolved shortage have become the same recurring event. Now the storefront no longer looks mysterious. New loans start the relationship. Repayments restore capital. Repeat borrowing adds fee revenue without finding a new customer. Defaults are tolerated as part of the portfolio. The lights stay on because enough customers can repay the lender before they can repair the reason they borrowed. The operator's final sentence is not that borrowers should have known better. It is quieter. The store never needed them to fail completely. It needed enough of them to succeed at repayment without succeeding at recovery. That narrow distance between paying and recovering is where the next Friday comes from. He locks the door and looks down the block. The laundromat is still turning. The phone shop is still lit. The same paychecks will arrive next week, and the same bills will arrive around them. If a business earns more when relief repeats, is it selling a solution, renting an exit, or doing both at once?